Alright, what's up guys? Hope you're doing well. James here from jamesdforsythe.com. Kind of wanted to start going and paying more attention to the news and stuff. So alongside also going through like papers and other articles and things talking about kind of the foundation of the monetary system as a whole. I think it's also important to actually watch what's actually happening now and today. Um, with respect to all the different monetary systems. So the article that we'll be going over is specific to the Bank of England, which their whole structure and how they function isn't I'm not as too familiar with. Um, but we're going to start kind of incorporating different monetary systems on top of the Federal Reserve as well. Kind of specializing in the Federal Reserve, obviously because I live in the United States, but just looking at the others as well to kind of understand how they function. Um, Maybe not go into as depth of nuance as I do with the Federal Reserve, going through the actual act and how all the facilities and things like that that will be popping up as videos on this channel. But regardless to say, we'll head straight into the screen share, going to an article from CNBC talking about the recent hiking, right? And so basically, the UK is pretty much in the same situation as the United States, it seems, for in terms of inflation. So their version of CPI, however they measure it, is at 9.4%, seems year over year for June, whereas America's was 9.1, I believe. And so, kind of in response to that, they're hiking again uh, for a 50 basis point hike to 1.75%. And I don't know if it's like if they're kind of I'm assuming it's their overnight rate or short term equivalent to what Fed funds is here. Um, but with that being said, I don't know if it's like a range or if they actually just have like a set rate, um, like the Federal Reserve has the Fed funds rate now, where they have the bottom and the top of the range, which is defined by like different kind of set rates that they have, like reverse repo, um, IOER, interest on excess reserves, things like that, right? So don't know if the technicalities on if that's different or not, but either way, they're hiking up to 175 basis points. So, being said, this seems to be the first half point hike that they've made since 1997, it seems. Um, right, and their inflation. This is also the 9.4 CPI inflation, whatever their equivalent is. I doubt they call it the CPI, but whatever their equivalent is, their inflation rate is 9.4% year over year for June, which is also a 40-year high. So similar to the United States in that respect, right? And so they actually, a Reuters poll indicated that over 70% of market participants anticipated a half point rise again. And so James Smith, it seems, is a developed markets economist at ING, said that although the economic data since June's 25 basis point rate hike has not moved the needle significantly, their prior commitment to act forcefully, in quotes, to bring inflation down and market and the market more or less pricing in 50 basis point hikes at the stage, right? And so basically, they're likely to err on the more aggressive side, it seems. And so, kind of, I guess, counter to that is even so, the window for further rate hikes feels like it's closing. So it doesn't think it's going to last very long. But they're basically pricing in the peak for their bank rate to be 2.9%, which is looks 60 basis points down from what it was at 3.5. And so, but that's still leaving in some two further 50 basis point hikes throughout December, right? So I think they have another one in September, it seems. Um, so yeah, it seems like they have another meeting in September where they might uh, hike rates and so on, right? So basically, he says the key point would be to watch out for in Thursday's report, which I'm assuming is today, the 4th. I think this came out yesterday. The actual article. I'm talking about the CNBC article. Yeah, it was published yesterday at 1 in the morning Eastern time here. So It's Eastern United States. So, yeah, let's see, and the forecast. So, yeah, basically just they're looking to see how much their version of the central bank uses the word forcefully in their, I guess, in their statement. So, like their equivalent of the FOMC statement. And so that kind of reminds me a lot of like needing to learn like Fed speak, as it's called, right? So, like, I didn't really understand this until I read Danielle DiMartino Booth's book, Fed Up, like how much is actually put into literally just the wording of the statements and like how much is it's like very specific words. And they actually have like, it almost seems like a, a significant degree of nuance between words that, you would typically think would be synonyms, but they're just like, they're very particular on which words they use and so on. There's actually a lot of nuance into like the difference between like slightly or minimally or whatever, right? I don't think that's a very good comparison, but I hope you kind of get what I mean, right? And so basically, they're worried about um, doing these hikes may fortify the bank's inflation fighting credibility, but the faster pace of tightening will exacerbate downside risk to an already slowing economy. Um, Typical kind of what you would think, right? The typical argument, the more you raise rates, the higher the slower the economy will go. And then they projected that inflation will likely still be rising, and then the bank rate will hike another 50 basis points in September, which I assume gets it to 225 basis points. Um, so it's still behind the Federal Reserve, but kind of catching up in a way, depending on how the Fed actually starts hiking. Um, so thereafter, the outlook is uncertain. Inflation will likely peak in October when the household energy price cap increases again amid growing evidence that tighter monetary conditions are weighing on demand and underlying inflation. We expect the BOE to hike by a further 25 basis points in November, but pause in December. So that's one thing that I don't know if it's a difference in systems, like the energy price caps. And so I'm assuming this is like the amount of like the cost of energy per household or whatever, to where like a household can't pay more than a specific amount. So it's kind of like a price control on energy for people. At least that's what it seems to be. I don't know if that's just something particular to to England or what, um, but I also like how they say it'll likely inflation will likely peak in October, and so like they already know what's going to happen. To kind of raising an eyebrow there, but I don't know. I always, of course, it always has to seem, especially from any form of, I guess, monetary authority or whatever. They always have to seem like they know what they're doing, or that they know what's going to happen and it's going to be okay. You don't have to worry about it. We're going to figure it out, or whatever version of that they spin off. Um, at least that's what it seems. And then also here, he suggested the BOE should be able to reverse some of the tightening during 2023 as inflation begins to roll over. Like we know that's when that's going to happen, and will likely cut the bank rate by 50 basis points next year with a further 50-point reduction in 2024. So it's one of those things, a lot can happen in 2 years. So it's kind of like a loose. Whenever I read something like this, obviously you don't just take it verbatim. It's more of as of right now, this is kind of what the market is pricing in, right? Is kind of how I think of it, right? It's kind of like from our perspective right now at this point in time, this is what it seems like it'll do in 2 years or whatever. It's kind of like I guess how you kind of interpret yield curves, right? How it's kind of like you could argue like pricing recessions and things like that, right? To where you're kind of seeing, okay, 10 years down the road, the market's thinking rates are going to be lower, and so they kind of hedge accordingly and so on, right? It seems kind of like that, or at least that's the way I think of it, right? And so this energy price cap, apparently they raised it by it seems 54% from April to accommodate soaring global costs, but is expected to rise by a greater degree in October, with annual household energy bills predicted to surpass 300 or €3,600, which is almost 4,400 bucks in US dollars, right? So higher inflation for even longer is the kind of scenario that spooks central banks because the higher risks of persistence and spillovers. And a lot of it too has to do with, I think, is inflation expectations, because that's really the major problem for central banks. And you hear them talk about it a lot. In that respect, is bringing expectations down, right? Because it's really that I think you have to separate kind of the monetary or and with inflation, even like supply side characteristics with like the psychological aspect of it, because you're dealing with you're essentially just dealing with money, right? Which is a very psychological thing for people. And so if people believe that, inflation is just going to keep going and so on, that then that switch happens psychologically, they're going to start behaving differently. And so you kind of get a, I guess, a death spiral, if you will, to where it's people start spending money as fast as they can, buying things they need, because that's the whole point of money is just to buy goods and services that you need. I mean, can't do much with just paper. It's what that paper can buy you that really matters. And so, that being said, they really need to rein in expectations, because if they lose that psychological aspect, they pretty much just got to throw up their hands and go, "Oh well," I guess. Which is why it was kind of surprising with, or that's why forward guidance was such a big deal for central banks. I'm not quite sure how much that would have changed. I've seen some things to where, or some people are arguing that with specific to the Federal Reserve, when they basically um, told the market they were going to raise or hike rates 50 basis points, and then they came in and surprised them with 75. That apparently it's kind of a loss of credibility that they, like made it worse than they said they were going to, and so it's kind of hard to. They lost the credibility for that. Is pretty much all I'm saying, or maybe not lost it completely, but it wouldn't be as high as before. And so now there's always going to be that little voice in the back of market participants' heads being like, are they actually going to raise as much as they said or whatever, right? So just kind of things to take away. Um, Big takeaways, I guess, would be more along the lines of it seems like all the developed economies are kind of doing the same thing relatively. So there's not so much. We're pretty much moving in unison to where like everyone's kind of hiking at the same time or easing at the same time. Um, and with some obviously being further behind than others, like how uh, the Bank of England isn't even above 2% yet. So there's that. There's also the, I guess, nuanced differences in like measurements too. So like how exactly does the UK measure inflation? Is it kind of similar to the CPI here in the United States, where like you have like owner's equivalent rent, and then you also have like X food and energy, and then you have little changes in how they measure things, right? So there's like substitutions or whatever, towards like and they kind of stop pricing in beef in the food part and pretty much kind of substitute it with chicken because beef is going too high or whatever the excuse is, right? Uh, Anyways, regardless, I'm going to put the link to the article in the description as always. I always do that with sources just so you guys can read it as well. So, with that being said, I'm going to leave this here. So, I hope you guys have a good night, and I will see you on the next one.